Let's discuss market internals and market fundamentals with Ajay Bodke, Head of Investment Strategy with Prabhudas Leeladhar Securities. Ajay, morning. Thank you for joining us. Ajay, a month ago, Indian markets were looking slightly oversold, but now they're looking slightly overstretched. Given the fact that Indian markets are up by about 12.5% from the May's low, what are you advising your clients?
So I think, as you've said in our strategy report, it all has the sea change in sentiment essentially has been driven by the reformist triumvirate of the new finance minister, Dr. Montek Singh Ahluwalia and Dr. Rangarajan. I think it is this reformist triumvirate that had helped overcome the crisis in the early 90s, and investors, both local as well as foreign, are putting a lot of store that they will be able to repeat that magic by pushing some of the much needed but politically unpalatable second generation reforms. In addition to that, I think the global risk on trade that had had a hiatus, I think that again has revived after this kind of semblance of sanity that has returned in the European markets. So I think both on the domestic and the local front, the environment has become a tad more supportive than it was a month and a half back, and that essentially has propelled the Indian equity markets to do quite well. And let's not forget that from 1st of Jan till date, we've had around $9.2 billion of FII inflows. India has been one of the strongest recipients despite the macroeconomic problems they've been facing, essentially indicating that the global investment community is still looking at a revival in the reforms agenda from the government. I think that essentially, in my view, has been responsible for the strong performance that we have shown, and the valuations are not expensive. In fact, in our view, we track 150 companies across various sectors, and our estimates for FY 12-13, that is current year, is that we will have a 16% growth in earnings. The Nifty earnings will be 394 rupees. And going forward in FY 14, we are looking at an earnings of around 446 rupees, a growth of around 13% to FY 13. So what are we trading at? We are today trading at around 13.5 times current year earnings and around 12 times FY 14, that is 1 year forward earnings. And traditionally, if we go back last 10 years, then India has traded around 13.1 times 1 year forward earnings. So there is still some scope for a re-rating to happen from the last 10-year averages perspective. The second parameter we look at is how does India trade vis-a-vis MSCI Asia ex-Japan. We've always traded at a premium because of our superior return on equities, strong earnings growth, etc. There, over the last 10 years, the average is around 38%, and we are trading at around 32% now.
Fair point, Ajay, that historically Indian markets are attractively positioned. But the fact that you are assuming that earnings for FY 14 and FY 13 will grow at about 13-14%, isn't that a very optimistic scenario? Because the investment cycle has broken down, auto sales have started feeling the slowdown hit, and Indian consumers either are tired or exhausted. On what basis are you confident that earnings from these levels, given the kind of environment we are in, will grow at about 14% plus?
See, essentially, as I said, this is a bottom-up exercise we have done for 150 companies, and despite the investment cycle that has currently slowed down, we feel that I think the measures that are being undertaken by the government will start feeding into the numbers as we go forward, and in the second half we are putting a lot of store that some of the infrastructure sectors, which clearly today have slowed down and are facing issues about high leverage, about access to credit, will be addressed, and sectors like mining, sectors like power essentially are the ones where the government is putting a lot of focus on. And the High Part Committee under Pulak Chatterjee, I think it is working on a war footing to tackle some of the issues that are dogging these sectors. So investment cycle, I think, will be will pick up only as we move forward over by the end of this financial year. On the consumption side, I do take your point. There is a kind of a slowdown that one is witnessing on the auto numbers. But I feel that there, I think, what is important in our view is how does the monsoon pans out. Because in the June has been particularly worrisome with 30% deficiency in rains. And if the El Nino effect does not materialize, and the IMD is pretty confident that we will have near normal monsoons in the months of July and August and September, then I think the rural consumption story will continue sort of to play out. And so consumption, which is the most important basket of the three drivers of the economy, will continue to chug along, albeit at a lower pace. And what we are forgetting is we are concentrating on the sharp depreciated rupee over last 1 year. In our interaction across companies in sectors like textiles, leather, chemicals, as well as BPO, I think what we have given to believe is that this sharp depreciation in rupee will be leveraged by a large number of Indian corporates in the medium term. Let's not forget that the yuan has appreciated versus the dollar by around 2 to 3% in last 1 year, whereas we are down upwards of 20%. So in terms of the relative terms of trade, right, I think India today is far better off than many of its competing countries.
Ajay, what are your thoughts on ICICI Bank? HDFC Bank is at a new all-time high, but ICICI Bank, which is again from the same basket, which is the private sector banking space, is nowhere close to its all-time high.
I think there were asset quality concerns that people had on ICICI Bank, and I think HDFC Bank has been has been one of the banks which has never had any asset quality concerns. So I think over the last 1 year, I think banks like Kotak Bank, HDFC Bank, IndusInd Bank, I think where there have been no asset quality concerns, people have piled onto them as safe havens. But I think as we go forward over next 1 year, and as we are expecting interest rates to slowly but surely come off, I think these asset quality concerns are sort of abating. At the same time, I think falling interest rates would also be helping the net interest margins of some of these banks. We are expecting a credit growth of around 18% system-wide, 16 to 17% system-wide, for the current financial year. So I think from this perspective, I think some of the alpha names like ICICI Bank, Axis Bank are the ones that we think investors will be better off getting in now, because the valuation gap between some of these banks that I mentioned, like HDFC Bank or Kotak, IndusInd on one hand, and Axis on ICICI is really widening, and there is a play, we believe, wherein these banks will outperform over the 6 to 12 month period. So I think ICICI is strongly placed out there.
I guess a very important classification about 6 months ago was PSU. The banking space was divided into two, PSU and private. Now within the private banking space also, we got outperformers and underperformers. HDFC Bank and IndusInd Bank, they've been marked outperformers. Similarly, Axis Bank and ICICI Bank, they've been massive underperformers. So within the private banking space also now, some degree of outperformance and underperformance now has kicked in. Ajay, let's extend that logic to BHEL also. Irrespective of the recent rally in some of the key infra names, BHEL is massively underperforming not only the infra basket but also Indian markets. Why is that?
See, I think the problem there is more of concerns on order inflow. I think for FY12 to FY17 5-year plan, almost all the orders on generation side have already been placed. So I think any further inflow of orders on the generation side for the BHEL will only come if with I think a couple of years lag. So I think what people are concerned there is not the near-term revenue growth, because the near-term revenue growth essentially is predicated on the orders that we have got 3 or 4 years back, because that's the typical cycle, 36 to 48 months for the generation projects that they undertake. But essentially, what is the order inflow? The book-to-bill ratio is what people are concentrating on, and there one is not expected to see a sharp jump for some time to come. So that's where I am saying that, the reforms in power sector are critical. I think once the fuel supply issues, import of coal issues, some sort of more leeway for private sector in mining, these issues are addressed. I think that's when one will see a clear buoyancy in terms of news flow for some of the generation companies. So till that time, I think people would be better off, in my view, sticking to names like Power Grid Corporation, where 1 lakh crores of capitalization is a given, 20,000 crores every year for next 5 years. So it's a more of a steady kind of growth that one can expect in Power Grid, and they are very well capitalized. They have good cash flows coming in, so funding is not an issue. So I would rather refrain today from BHEL and look more at Power Grid Corporation.
Okay, Ajay, good speaking with you. Appreciate you taking the time. Thanks very much as always for joining us on the show.